All right, in this lesson, we're going to walk you through some unique situations when it comes to depreciation that you should understand and know as you're doing problems and calculating depreciation for long-lived assets. So let's kind of walk you through these unique situations. The first one is the depreciation and different classes. So companies do not need to choose one depreciation for all of their long-lived assets. They can actually use different depreciation methods for different classes of assets. So most companies will only use one because it keeps it simple. Then we don't have to think about it. But if you feel like you want to use straight line for one set of assets and double declining for another set and units of production for a third, you can definitely do that. The key here is you got to be consistent. So once chosen, that class of asset needs to stay that way until, well, it just needs to stay that way. So just leave it as straight line forever. Because you're going to have a consistency issue on your financial statement. So making sure that you can have different ones, but you got to be consistent. So most companies, for the simplicity, will use one type like straight line, which is usually what they use because it just makes sense. And it's super easy for someone to understand, especially a new college grad who is doing all the depreciation calcs for a company. So again, you can use multiple depreciation methods as long as you keep it consistent from year to year. The next kind of unique situation is partial year. So partial year depreciations. Up until now, we acquired all assets on January 1 of the year. In reality, companies never acquire assets on January 1 because they're usually off for that day, or maybe the stores are closed so they don't get anything anyway. So most companies do not acquire on January 1. Companies buy assets throughout the year, and as such, we need to prorate our depreciation expense based on a fraction of the year in which we first acquired the asset. So understanding the best way of doing this is looking at the date. When did we acquire it, and how are we going to allocate it? So sometimes a problem will say, we are going to, for any partial month, include that as a full month. So meaning that if we acquired on March 1st, then we would start the depreciation on March 1st. If we acquired on March 21st, any day of the month, we assume that it's a full month. So even though we purchased it at the end of March, we're going to assume that we bought it on March 1st of that year and take a full month's depreciation. So, read the problem first. But we're going to have to prorate the year based on that time frame, okay? So when it comes to partial year, this only applies to straight line and declining method only because those are time-based. Units of production does not have a partial year depreciation. So if your units of production, this is not even an issue. It's just what it is, okay? So we don't prorate that. If we use 200 machine hours, we don't prorate because we acquired it half the years. Nope, we just use 200 units of production to calculate units of production depreciation. But for straight line and double declining, which is constant time based, those we're going to actually have to prorate based on the amount of months or days or weeks that we've actually acquired the asset. Now, so an example to calculate partial year, take the annual depreciation and multiply it by the fraction of the year. So if we acquired the asset on May 1st, then the first year would be 7/12. May, June, July, August, September, October, November, December. So 8/12, not 7/12. You know what they call CPAs? Can't possibly add. Okay, so 8 months, not 7 months. So May, June, July, August, September, October, November. So 8 months. So we will multiply our yearly depreciation by 8/12. So 8/12 because there's 8 months in a year, 8 months in this period over 12 months in a year. So 8/12 is what we're going to use. And then that's going to give us an amount less than the yearly depreciation. That's what we're going to use for year 1. And then in that final year, you're going to notice that we're going to catch up by doing 4/12 to catch up for the rest, okay? So when we do partial year, break it up so that it is for the actual partial year and then follow the instructions in the problem that tells you how they calculate a partial year. All right, lastly here is tax depreciation. Tax depreciation is typically different from financial accounting. In tax depreciation, we usually follow the declining method and could include an upfront amount prior to calculating the declining method. companies can have a different financial accounting depreciation than a tax depreciation because companies want to pay less taxes. So what happens here in the tax law is that for taxes, there's usually an incentive to depreciate more upfront, which would give you more expense upfront, which would decrease your net income on your taxes, and then you pay less taxes. So there is situations where, from a tax perspective, we want to accelerate the depreciation expense because it lowers our taxes at the end of the day. Now, GAAP says we need to use a systematic allocation approach, and we can't follow tax. So when we look at our GAAP financial statements, they are not the same usually to our tax. So for GAAP, we'll use straight line. For tax, we'll use whatever the tax code says. Tax code says you can depreciate 50% of the asset's value in the first year, and then the rest of it use what they call makers. Okay, so which means you might depreciate 65% of the asset in year one for tax, but only depreciate 10% for GAAP purposes, financial accounting purposes, and that's okay. You're going to have a difference. It's called a tax difference, and that is okay. So you're not going to calculate any tax depreciation in this course, but just wanted you to know that tax depreciation is going to be different than financial accounting or the depreciation that we're doing in this section. So that is a look at a few unique depreciation situations. Again, walking you just through some of the nuances of, what companies can use, what they can't use, the time issue with a partial year depreciation, and then finally the tax depreciation issues that might come up when it comes to understanding the difference between what we're putting on our books and what we're reporting to the government. So hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or clicking the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.